Good morning, ladies and gentlemen, and thank you for waiting. We would like to welcome everyone to Bradesco's first quarter 2020 earnings conference call. This call is being broadcasted simultaneously through the internet in the investor relations website, banco.bradesco/ir-en. In that address, you can also find the presentation available for download. We inform that all participants will only be able to listen to the conference call during the company's presentation. After the presentation, there will be a question and answer session when further instructions will be given. Should any participant need assistance during this call, please press *0 to reach the operator. Before proceeding, let me mention that forward-looking statements are based on the beliefs and assumptions of Banco Bradesco's management and on information currently available to the company. They involve risks, uncertainties, and assumptions because they relate to future events and therefore depend on circumstances that may or may not occur in the future. Investors should understand that general economic conditions, industry conditions, and other operating factors could also affect the future results of Banco Bradesco and could cause results to differ materially from those expressed in such forward-looking statements. Now, I'll turn the conference over to Mr. Carlos Firetti, Market Relations Director.
Hello, everybody. Welcome to our conference call for discussing our first quarter 2020 results. We have today with us our CEO, Otávio de Lazari Jr., our CFO, André Rodrigues Cano, the CEO of Bradesco Seguros Group, Vinicius Albernaz, and our Executive Director and IRO, Leandro Miranda. After the presentation, we will run a question and answer session where you're going to be able to post your questions. Now I turn the presentation to Leandro.
Thank you very much, Firetti. Good morning, everyone. I hope you and your families are well, and I welcome you on our conference call. Today, we'll discuss the results from the first quarter of 2020 and once again talk about our positioning during this rather difficult time. This quarter has wound up quite different from what was taking place up to mid-March, when we were performing very strongly in a number of lines, even above our guidance, as you may see ahead. The scenario was radically altered by the worsening of the COVID crisis in the second half of March. Nonetheless, we highlighted our balance sheet remains very strong. From the moment that the crisis rose to the scale that it is today, our priorities have changed completely. We focused on maintaining our services to our customers and keeping the bank fully operational, along with the well-being of our employees. And we are committed to supporting society in overcoming this crisis. All stakeholders are important, and we keep a very keen eye on each one of them. I'm proud to state that through the efforts of our entire team, the bank adapted quickly, above expectations indeed, in continuing to operate in such extreme conditions, while always accounting for the safety of our people and customer as the primary parameter. To give you a reference, today, more than 90% of our staff that normally work in our offices are now working from home. And 50% of the teams from our branch network, which we consider as an essential service, are at home. We are also striving to resolve any liquidity issues our customers may be experiencing by initiating a process for rolling over that is maturing for at least 60 days for small companies and individuals, and opening a direct line of negotiation with large companies. We have also been working jointly with other banks and the central bank, as well as on the NDS, on structuring lending to finance small business payrolls, and we have discussed other measures with the central bank and Febraban as well. As mentioned before, Bradesco and all other banks have every interest and duty indeed to help customers emerge from this very difficult time with the capacity to fulfill their commitments and resume their lives without facing financial ruin. We also, as we mentioned in our COVID call, differently from previous crises in which the financial sector was the main responsible for the crisis, this time in particular, as our CEO have been telling over and over again, we are an important part of the solution and we embrace this responsibility. In view of the uncertainty inherent to any projection at this time, especially considering that we still don't know for sure when the shutdown will end and how the pace of the resumption will be, we have decided to suspend our guidance for 2020. We will outline a new guidance when we have a sufficient clarity of the situation and our administration will decide on that. Meanwhile, we should stress that we do not see our ability to generate sustainable returns fundamentally altered. The operations are sound and good. In addition to the return of revenues and resolving loan issues, which will take place with the recovery of the economy and a return to normality, one of the ways to recoup our return is through an essential adjustment in costs, and we have done it very toughly. We have already performed quite well this quarter, thanks to the initiatives we took at the beginning of this year to control costs throughout 2020, as well as in March due to the effect of the crisis in some lines. Nevertheless, our new experiences in managing the bank during this period should allow us to accelerate cost adjustments. We see even greater opportunities for adjustments in the branch network through the use of new, smaller formats as well as lower costs. The primary focus on conducting business and providing consultation and providing advisory to our customers will seek to harness and train our talents in a new way to serve our customer base. Another key focus during this time was on risk management. In order to provide support to the country at this time and to our society as a whole, it was important to keep the bank liquid and very well capitalized. We headed into the crisis with a strong capital position and elevated liquidity levels. We ended the first quarter 2020, which already reflects the period of market stress, with a comfortable 11.4% Tier 1 ratio. Furthermore, we saw an increase of 6% in deposits and customer funds, a clear flight to quality. Our expanded loan portfolio had a strong growth, posting an increase of 5.1% over the quarter and 17% for the last 12 months. Part of this expansion can be explained by the effect of exchange rates, and part of it is due to a strong increase in demand, mainly from large companies at the beginning of the crisis. Our delinquency grew by 40 bps. We believe that we are preparing ourselves quite well in terms of credit provisions to face the impacts of the default that will be triggered by the crisis. We have increased our excess provision this quarter, posting a provision of 5.1 billion reais in our balance sheet to face the consequence of the pandemic of the credit. Our objective is to preserve our balance sheets. We see similar measures taken by other global banks, especially the largest U.S. and European banks such as ourselves. As for our first quarter results, we posted an income of 3.8 billion reais, a decrease of nearly 40% over the 12 months and 4.5% in the quarter, with a return on equity in the quarter of 11.7%. Income and return for the quarter were adversely impacted by the excess loan loss provision that we made this quarter, along with other effects related to market conditions. Now we turn to slide 4, related to the suspension of our guidance for the year. Although it's not usual, in order to be more transparent, we included in the table a column with our performance in the month of January and February. I'd like to remind you that in the first 2 months of the year, we don't have our full capacity, as 60% of our general managers, account managers, investment advisors, bankers are on vacation. You can see that we have very strong numbers, even better than the guidance, except for the insurance business, mainly due to the financial results. Until February, the credit portfolio was growing 14.4%, NII 11.7%, fees by 3.6%, costs on the other hand were dropping 0.1%, and we had a good performance in loan loss provisions. We decided to suspend the guidance without presenting a new one because pretty much we do not have clarity and a vision of all the effects that this virus may have over the economy. The outlook remains rather uncertain, and there is no cure for the virus nor precise definition on the time of recovery for the economy. We establish a new guidance when we have a better capacity to provide an outlook, and our administration say so. Moving ahead, following to slide 5, regarding to provision and credit risk, you can see that when the scenario was becoming stressed, especially in the second half of March, we involved several areas of the bank in carrying out an in-depth study of the possible and uncertain future scenarios, as it was clear that the rhythm of credit growth would slow down and the delinquency speed up, in fact increasing numerator and decreasing denominator. 2 working groups were formed, one composed by the credit and credit recovery teams, and the other one by the risk and economic teams. They both studied past crises, estimating the future impacts in delinquency and revenues, both in retail and corporate credit. Despite of using different methodologies, the results were pretty much the same. And it guided us in our provisioning measures to face the COVID crisis. Now, turning to slide 6, we map the behavior of the mass market credit NPL in the global crisis of 2008 and in the Brazilian crisis of 2016. And we projected a very uncertain scenario for this COVID crisis, which affects all sectors in different scale. Our perception that booking additional excess provisions to face future credit loss was necessary, also confirmed by the other banks that released their earnings, especially in the US and Europe. Now, turning to slide 7, regarding to the provisions that we took in order to deal with this adverse economic scenario. In light of this study, we have already set up an excess provision of 4.9 billion, a total of 5.1 billion reais to cope up with the effects of the pandemic in our credit portfolio, and we shall use it through the crisis. We believe this provision is suitable at this particular time and reflects information we have at this moment. We continually be evaluating the need of provision for this crisis as we monitor the evolution of the economy as a whole, and especially the health issues that we have here. The provision includes 2.4 billion reais related to what we refer to internally as the provision for an adverse economic situation, which is part of our previously existing supplementary provision and will be used throughout the crisis. New supplementary provision for an adverse economic situation of 2.5 billion reais made this quarter, and 200 million reais of required provisions carried out this quarter due to the effects of the crisis. Moving on next slide, slide 8, you can see that we rapidly provided our customers as individuals and as small business with access to credit instruments, due date extensions through our digital channels, call centers, and through our managers. We use all of our network to help our clients. We were also the first bank to provide access to payroll funding for our clients. We have already extended more than 1 million transactions with instruments in the amount of 1.4 billion reais. We have been constantly evaluating the financial situation of our customers and offering the best solutions for each one of them, either a credit extension or a restructuring of the entire debt. It's worth to highlight that among the measures announced by the central bank, we had 24.1 billion reais of reserve requirements released. But although the number of 24.1 billion reais, we were able to originate 57 billion reais in new loans between March 16 and April 23rd, almost double, more than the double than we had in reserve requirements release. Now turning to slide 9, we have already spoken about our priority at the beginning of the crisis, taking care of our people, keeping our services running smoothly, assisting in overcoming the crisis and managing the risk that the new scenario have imposed on us, and keeping the bank capitalized and liquid. We can state that we have been successful in all of the 3 pillars at this initial phase, and we continue to work hard, and we are confident that we are going to continue to be successful in our missions. We have set up a true war operation in order to turn our business into a primarily home office-based activity. We had a small-scale structure in place, but we were able to expand it very, very quickly. Today, as I stated before, more than 90% of our employees that do not work at our branches are now working from home. We have to thank all the teams involved in this process, our senior management, and especially our technology and system staff, and also our branch teams for continuing to serve our customers in this essential activity for the population. Now moving to the financial results, we start here on page 11 to discuss the figures of the quarter, in which we have already experienced a major impact from the unfortunate events we faced in March, as well as the society as a whole worldwide. Our net income was 3.8 billion reais, a decrease of 39.8% over the last 12 months. Some of the factors that contributed to that drop included a supplementary provision for loan losses of 2.5 billion reais to address the COVID effects on loans, 200 million reais of required provision due to the crisis, a reduction of our margin with the market due to the effects of the price in the market and the mark-to-market effects, a decrease in the performance of our insurance company, primarily due to the lower financial results, consequence of positions in equity, and the mismatch of inflation in the index inflations, namely IPCA and IGPM, among others. Lower tax benefits due to a reduced provision for interest on capital in this quarter. Now turning to slide 12, our ROE in this quarter posted a significant reduction, settling at 11.7% as a result of everything that we have just presented to you. And the same fact can be seen in our ROA. Our shareholders' equity was reduced by 3.1% in the quarter due to the negative impact of mark-to-market of assets. So as the economy evolves and the market gets less volatile, we shall have also recover of the shareholder equity due to the mark-to-market of the assets. Now, turning to slide 13, the loan portfolio registered an expressive growth of 17% year-on-year and 5.1% in the quarter, with 2.6% in individuals, 7.6% in large companies, and 4.4% in SMEs. Part of this growth can be explained by the effect of exchange rate fluctuations on the loan portion in dollars, mainly the large companies portfolio. Excluding the effects of exchange rate variations, our portfolio would have grown by 3.4%. In addition, there was a strong increase in demand for loans by large companies in March, notably in the second half. Companies sought to set up a liquidity buffer at that time, but the situation has returned to normal. In individuals and SMEs, the growth in the quarter largely reflects the strong performance we had been posting up to February. We expected a slowdown in growth in the coming quarters, but it is still very difficult to foresee the size of the reduced demand for loans. On slide 14, we can see that the total NII decreased by 6% in the quarter and increased by 2.9% year-on-year. The reduction in the quarter is related to the performance of the margin with the market. The margin with clients increased by 8.4% over 12 months, primarily as a result of the increase in loan volume, which more than offset the negative impact the regulatory cap on overdraft limit interest rates. The margin with the market decreased at 37%, especially due to the impact of market volatility, and in this case here we are referring to market of our trading portfolio. Turning to slide 15, we have an increase in NPL creation this quarter, already reflecting impact of the pandemic of the loan portfolio, and in the end of March, any specific cases in our corporate segments, as well as the growth of the loan portfolio and the shift in the mix. It's worth mentioning that the NPL creation in the third and fourth quarter were already affected by a large corporate credit that became due and was later renegotiated, for which we already fully provisioned. It's much easier to make a comparison if you make those adjustments. Our expanded loan provision amounted to 6.7 billion reais, including the impact of the supplementary provisions of 2.5 billion reais and the required provisions of 200 million reais. They were pretty much done due to the effects of the crisis and credit. The provision in relation to the portfolio that we refer as cost of risk is stood at 4.1%. Moving to slide 16, regarding to the delinquency ratio over 90 days, pretty much we see it increased by 40 bps. The reasons are the same as the ones we gave for the progression of the NPL creation. On the following slide, we can see that the 90-day NPL coverage ratio was 228% in the quarter. As we mentioned before, we had a provision of 5.1 billion reais for the adverse economic scenario. We shall consume these provisions throughout the crisis, what may reduce our coverage ratio in the following quarters. In addition to the consumption of the provision already booked, we will constantly adjust our scenarios to evaluate the necessity of new provisions. Now on the slide 18, we refer to the fee income that we have in our different lines of business. As you can see, the fees decreased in the quarter by 6.2% and increased over the 12-month period by 2.6%. We have experienced negative impacts on card income, which reduced it by 7.1% quarter-over-quarter, and 2.4% year-on-year, mainly impacted by Cielo and interchange fees. We also had negative impacts in the lines of asset management and loan operation. The check-on accounts, on the other hand, performed very well, growing 7% year-on-year, mainly due to the increase of customer base. Custody and brokerage services was positively impacted by the growth in volume in both the institutional trading as well as the individuals trading through Agora, our investment house. We'd like to highlight the evolution we had in Agora, Bradesco's new investment house. It has a complete portfolio of products with a redesigned platform, which is very user-friendly, and a careful selection of the best investment products in the market to each kind of investor profile. In addition, Customers have access to specialized investment advisors, content provided by other research teams, and now the largest JV regarding to financial content with the Grupo Estado through the investor channel, and also recommendation by market analysts who support in taking better decisions when investing. By the end of first quarter 2020, we reached 416,000 clients, a growth of 13.4% compared to the last quarter, but a strong growth of more than 246% in equity transaction volume in the same period. Operating expenses on the following slide 19, you can see that we operate very, very well in terms of operating expenses with a reduction of 0.4% over the last 12 months. As our CEO has repeatedly said, we are aiming at having a 0% growth in 2020 as far as operating expenses are concerned. We saw a sharp slowdown in annual growth related to administrative and personal expenses and strong reductions in both lines for the quarter. This performance is mainly due to the measures we have taken to reduce costs at the beginning of the year. Although our guidance for 2020 is from 0 to 4%, our goal, as I mentioned, was zero growth. Additionally, the reduction in operation volumes in March has already had an impact on lowering our administrative expenses. We reduced 78 branches in the first quarter, with expectations of closing more than 300 branches in 2020, and a reduction in the number of employees due to the voluntary dismissal program. As we mentioned earlier, the experiences we have lived in the environment of the COVID crisis, such as home office, a boost in the use of self-service by customers, and remote customer service have opened a space for a profound restructuring the way we operate. We see room to expedite the conversion of branches into customer service points and cut back on traditional branches. For our staff that does not work in the branches, we see an opportunity to continue using home offices and reducing the amount of occupied space. Now, finally, moving to insurance, pension plans and capitalization bonds. In our last slide here, we can see that there was a major impact on the financial performance due to the effect of market volatility on the portfolios, especially on equity portfolio and multi-market investment funds. In addition, we had the effects of the lower Selic and negative impact of the mismatch of IGPM that corrects our liabilities and IPCA that corrects part of our guaranteed assets, which affects our ALM. On the one side, we know that the financial results will be a challenge. On the other side, we continue to see an important improvement in terms of operating performance, with a reduction in the loss ratio compared to fourth quarter 2019, which resulted in the improvement of the combined ratio. The insurance group has been monitoring the economy and business effects caused by the new pandemic effects. We understand that the importance of our product as an instrument to help and support the resumption of the families that may eventually be victimized. Several actions were taken to ensure that the best service and security and adjusted to the reality presented through an exclusive call center, adjustment of the operation of the primary care clinics that since the beginning of the pandemic have been operating at extended hours and even in the weekends from Sunday to Sunday. So this initiative also serves to relieve the demand for emergency care and emergency. With the beginning of the social measures, we started to observe changes in the behavior of events. And at Bradesco, for example, if on the one hand there was a stark reduction in the elective procedures, on the other hand, it was already possible to see a gradual growth in emergency and hospitalizations due to the new virus. it's worth to mention that these elective procedures should be resumed ahead, as social isolation is easy. Although it's premature to make any kind of projection at this time regarding the future of behavior of these events, it's estimated that their effects will tend to get worse in the coming periods. And we were cautious to make provisions on that. In auto insurance, the decrease in urban circulation caused a momentary change in the frequency of claim notice, motivated by the closing of repair workshop, as well as the beginning of the drop in the sale of new vehicles, reflecting the sale of new insurance, directing the focus towards policy renewals. Having said that, we open for the Q&A session, and we remain at your disposal. Thank you for your attention.
Thank you. We will now initiate the questions and answer section. If you would like to ask a question, please dial *1. If at any point your question has been answered, you may remove your question from the queue by pressing *2. Our first question comes from Mr. Mario Pierre with Bank of America. You may proceed.
Good afternoon, everybody. Thank you for your presentation. Let me ask two questions, Leandro. You mentioned that you expect, I think in the Portuguese call, that you guys expect the NPLs in this cycle to be higher than in the 2016 cycle. At the same time, you know, the amount of provisions that you took this quarter of 2.5 billion reais, you think that's enough to cover this, some of this expected increase. But, you know, I'm just trying to put in perspective this 2.5 billion reais, right? Because it doesn't seem like that much given the size of the crisis. And if you are trying to anticipate some of the losses, why not take a bigger provision this quarter? So that's my first question. You know, like, is this 2.5 enough, and why didn't you take more? And then my second question is related to your slides on page 26. We see that NPL creation in the SME segment more than doubled in one quarter. So I wanted to understand, you know, why are we seeing such an increase in NPL creation before the crisis even hit? And if there are any specific sectors or regions where you're seeing this big pickup in NPL creation in the SME segment. Thank you.
Okay. Hi, Mario. First of all, the provision that we consider is not 2.5, but 5.1, because we had previous provisions that were added to this. Otherwise, we would have increased it even more. We believe that this is a new crisis. We have never experienced anything like that. And so in this sense, we have been discussing to analysts and to our clients as a whole, and there is a common sense that no one knows when it's going to be managed, when it's going to be finished, and what would be the total effects of in the economy, because you do not know when the full recovery shall happen. If we had a clear scenario that would be even worse than 2008, we should do exactly what you have said. But on the other hand, according to the information that we have today, according to the lockup canceling that's about to happen, we believe that 5.1 billion reais is adequate at this point in time. But that's the reason why in the Portuguese conference with our CEO, Mr. Resultado said that we are prepared to continue provision as we get more information on the outlook of the economy and clients if it's necessary. Regarding to SME NPL criteria creation, in which you have seen a stronger growth than the rest, a couple of things to point out. First of all, we still haven't seen a full program for all the SMEs that we have seen in the country. We have taken care of payroll for individuals. We have made refinancing of all of our clients for 60 days, but the SMEs they have less liquidity than the large companies, and that's the reason why you see faster NPL creation here. I do not know if any of my colleagues want to complement on that.
Yeah, just on the NPL creation for SMEs, adding to Leandro, what I said in the Portuguese call, basically this quarter we had about 500 million reais in new NPL in the large SMEs. We have in the SME portfolio, SMEs up to 30 million reais. That is the retail part of the business that basically is running smoothly. But in the other part that goes up to 500 million reais in annual revenues, basically we had three cases. One of them amounting 300 million reais that moved to 90 days delinquent. All of them fully provisioned. And this is basically the main reason for this jump. The fourth quarter actually was lower, mostly given the regularization of some SME loans at that quarter, so the base is low. Probably the fair base for this SME portfolio is more like the third quarter and before. So basically the answer is this. The jump is mostly related to this 500 and also reflects what Leandro said.
Okay, let me just one follow-up then. When we look at the provisioning level, right, your amount of provisions, they were lower than the NPL creation, and I get it. You had some previous NPLs that you had already provisioned for, that they were not officially NPLs, I get it. But if we look at your reserve coverage today of about 229%, if we go back to the 2015-16 crisis in Brazil, your coverage ratio was running at about 190%. Is that the level that you think should be appropriate in this cycle to maintain a coverage ratio of 190? Or given that this is a worse cycle, that you'll be more prudent to be more conservative and maintain the coverage ratio well above 200%?
Mario, as we always say, in your question there is a wrong assumption that we manage the coverage ratio. The coverage ratio is much more an output of our provisioning methodology. So basically, we're not going to do anything different because the coverage ratio moved to any level. That said, in the cycles, basically you have normally a consumption of coverage in the sense that in the normal process of provisioning, you end up writing off part of your provisions, and in that process, let's say, the output of coverage tends to get lower.
All right, guys. Thank you very much.
Thank you, Mario. Take care.
Our next question comes from Mr. Tito Labarta with Goldman Sachs. You may proceed.
Hi, good afternoon, everyone. Thank you for the call. A couple of questions also. Following up just on the NPLs, just to understand a little bit more, given, first quarter was really just the last 2 weeks of March that were impacted by the crisis. So is it fair to assume that this increase in NPLs should get even worse as you see more of the impacts of the crisis? Just to understand sort of the magnitude related, I guess, to the one-off that you mentioned and the increase in NPLs. I mean, is it fair that that's going to continue to deteriorate at sort of a similar pace or even higher? I guess that's the first question. And then my second question is on capital. We saw a significant reduction in the core tier one. I know part of that was FX, the mark to market, and the growth in the portfolio. But if you can help us just think about that, I mean, your capital is okay now, but if you have another 200 basis points reduction in the core tier one, then it's maybe a different conversation. So given the level of growth that we saw in the quarter, the level of ROE, if you can just help us think about how you're thinking about your capital base, given all these moving parts. Thank you. Okay,
Tito, let me start from here, and then Firetti would like to give his 2 cents. Well, first of all, it's very unusual to make comments on the second quarter that is just starting, and we have a crisis that we, all over the world, have never faced before. So it's very difficult to tell you how we see the behavior from now on. But the good part of the second quarter is that we shall start seeing the cancellation of a lockdown by several states, and we'll start to see some clients getting back to the game again. So that will be the most appropriate time to understand how we shall see the behavior of the NPL creation from now on. So we are not in a position to give you a very good and clear answer regarding to how it's going to be the behavior of the NPL creation from this point on.
Mm-hmm. Tito, just to complement, basically we said, the others said, or still said that basically we believe this crisis may be, in terms of NPL, worse than the 2016-15 crisis. That implies actually that to reach that, the NPL will continue increase for some more time. Basically, the NPL, what I'm saying about the specific cases, there is this 500 million reais already provisioned in SMEs. There's also something around 500 also fully provisioned that moved to NPL this quarter in corporate. So we have about 1 billion for which we already had provisions, and as you know, we had built provisions even in the fourth quarter last year. So this is kind of changed, made the acceleration in NPL faster this quarter. Probably then it would be the normal pace otherwise, but probably the NPL at the end of the cycle should really be higher than this.
And the second part of your question regarding to our capital structure and effect on shareholders' equity, it's important to highlight that a significant part of this reduction in the shareholders' equity was due to mark-to-market effects on the securities that we have. So as we get a better environment from now on, we shall see recover there as well. We do not plan to make any sort of capital increase. We do not plan to make any sort of capital shares buyback. So we believe that as the normal business gets back, we shall have the appropriate composition of our capital in the previous levels, as we are profitable and we just are about to distribute the minimum dividends according to the central bank provisions, and we shall keep it for quite a while.
Yeah. On top of that, we also should consume the tax credits from the hedging generated this quarter. I think we, as pointed, we have profitability for that. And also the loan growth should slow down. Basically, the size of loan growth we had this quarter is a mix of the good performance that we were presenting until February in terms of loan growth, plus the extra demand we got from corporates. This level of growth certainly is going to be slower for the rest of the year as we have a correction in loan demand.
Great, thank you.
Thank you very much for your
Very
questions.
helpful. That's very helpful. I mean, just one follow-up, I guess, on the first one. I understand the uncertainty in trying to predict where the NPLs will end up, but you have another month now since the end of the first quarter. So I guess I was also thinking in terms of the evolution from just the last 2 weeks of March and into April, and how sort of the NPL formation I don't know if you can give any color at this point, but just how that may have evolved or gotten worse or maybe leveled off at some point.
Yeah. At this point, we prefer not comment on the more recent trends. It's basically, it is, again, we have the renegotiations of loans for 60 days. This is providing a relief on the delinquents, given that you roll in these clients, they don't go to NPLs. We also are working on all clients to provide them the best solution possible to be able to meet their obligations. And so I think it's an ongoing process that somehow mitigate the evolution of NPLs. But I think it's still too open to say something.
But Tito, as Otávio has previously said, if clients need, we are open to support them in providing additional renewal of 6 days, or even to restructure their debt in a way that we can preserve their health and have a long-term relationship with our clients. So this is something that we are wide open to help clients and society as a whole.
Okay, well, thank you very much.
Thank you, Tito.
Our next question is coming from Mr. Jason Mollin with Scotiabank. You may proceed.
Hello, thank you very much. My question is somewhat of a follow-up on the provisioning levels made in the quarter. And you show on page 7 of your presentation that you had 2.4 billion in pre-existing provisions for adverse economic scenarios, that you created 200 million reais in provisions that would be required under traditional regulations. That my understanding is that the regulator would have allowed you not to make those because of restructuring in the quarter, plus this 2.5 billion that you've been discussing in new supplementary provisions. Now, I guess I'm trying to understand the decision-making process here. I understand it's not, as you've said many times, about reserve coverage, etc. But can you talk about making this decision? What are the implications for taxes, creating deferred tax assets, implications for dividend payments? Obviously, you reported a much lower bottom line, but in my view, this is a prudent, conservative approach going into a crisis where we don't really know the real losses, what they're going to be, and what are the implications for just reversing these going forward. Thank you.
Thank you very much for your question, Jason. I guess we totally share your view regarding to the behavior in a crisis like that. We do have to be conservative to preserve our capital in order to serve our clients adequately. And there is a central bank ruling saying that the banks are not allowed to distribute dividends higher than the minimum amount required. The law says that the minimum amount required is 25, but bylaws can state differently. Our bylaws state 30%. And we'll keep up with behaving and respecting this regulation, so we shall not expect dividends higher than 30%. We have no internal discussions on reducing the dividends. we believe that we shall have to leave this new environment, this new scenario, to make adjustments in our provision, as the case may be. The capital structure is very, very strong. We remain confident that we can help our clients to get back to the liquidity levels they need in order to get back to their basic activities.
I mean, maybe I can ask, I mean, again, it's not a metric. I know this is not how you make provisions, or any bank doesn't, but it's an interesting reflection on what's going on. If you look at the loan loss provisions created in the quarter, I think it was something like 46% of the way I calculate net NII, net interest income, was provisioned away. You had been running at around 25%. I looked in my model, and I think at the peak levels that I've seen probably in the last 15 years was something like 55% in one quarter, but really doesn't get much above where you provisioned this quarter. So is this kind of a limit when you look at, of course, it's based on what happens in the economy and the ability, the likelihood of your clients paying and their payment performance. But does this seem like, when you look at that kind of metric, that this is extraordinary and a level that is not expected?
First of all, you have to consider that we have established last quarter a provision for adverse market conditions. We did not expect to use it so soon, but fortunately we were with a very good protection for that. So the way that we see is that you do have to take into account the whole 5.1 billion reais package, because that was the sum of the protections that will face all the delinquencies and losses that we may have from now on. But of course, this amount was, as we have pointed out, the result of the analysis of two different teams here, the credit as well as the risk and our economic teams that have put together with our senior management. We decided that this is the adequate provision at this time, according to the information and vision that we have over the economy as a whole. So we do not take into a measure specifically the way that the NPL creation in the last fortnight, because pretty much it's extremely soon to say that. But if it proves to be right, we're going to keep it this way. If we have to be even stronger in terms of capital measurements and provisions, we are prepared to do so. But keep in mind that we have previously provisions for adverse market conditions such as this.
Thank you very much for the context and color. Much appreciated.
Take care, Jason. Thank you for your question.
Our next question comes from Mr. Thiago Batista with UBS.
Yeah, hi guys. I have just one follow-up question about the capital position of the bank. If not wrong, the bank was targeting in the past a Tier 1 ratio close to 13% or something around this level. It's fair to say that the bank continue with this, let's say, informal target or with this target of Tier 1 capital of around 13%. And if it's fair to say that the bank payout ratio will be close to the minimum until the capital return to this level.
Oh, sorry. Go ahead.
No, sorry. And second question, a very, very small one. Can you comment a little bit how challenging is nowadays for Bradesco to sell insurance in the branch and also to sell fees? So how important are the flow of individuals in the branch? That's for sure. Right now, you don't have this flow of individuals.
Maybe we can start with the second, then answer the.
Why don't we invite Vinicius?
Yeah, we're going to invite Vinicius to answer the second one.
Hi, Thiago. Vinicius here. The branches are very important, mostly for the sale of pension-related products, capitalization products, and life. Okay, they are very important. We have, of course, for life and for auto insurance, the presence of our insurance brokers in our branches. And what we've been seeing, I mean, in March we didn't feel because we have a full month almost of normal operation. We have a gradual decrease in business in the end of March. But what we've been going through right now is to be able to give our branch managers, sales people, financial advisors, as well as our insurance brokers, all the tools necessary for them to operate fully on a home office basis. Okay, so we've been seeing this gradual improvement in sales of our sales force of our different channels from home office. Okay, but there is a considerable investment right now in digital, in CRM tools in order to give support to these sales force.
Tiago, regarding your first question on capital, basically, I think the level of capital is constantly being evaluated by the bank. As you know, the regulator reduced recently the minimum capital requirement by 125 bps. Any consideration regarding what is the optimum capital surely takes into account the regulatory requirements in terms of minimum capital. On top of that, we have to consider that we are getting to a cycle where actually loan growth should be for some time much weaker than it was so far. So it allows us actually we should use less capital going forward. And on top of that, we do believe we're going to consume relatively quickly the tax credits we have generated and are one of the main negative impacts in our capital this quarter. And also, we believe that part of the market-to-market should be reversed soon. So in that situation, in that scenario, we think we are in a very good position in terms of capital. We don't have a public target on capital. We haven't been discussed on those terms for some time. But again, I think given what I said, we are, in our view, in a very, very good position.
Okay, thank you for that, and thanks, Leandro.
Thank you, Thiago.
Our next question is coming from Mr. Marcelo Telles with Credit Suisse. You may proceed.
Hi, hello everyone, and thanks for the opportunity. Most of my questions have been answered, but I want to understand from you, what is the risk that you see in the large corporate sector at this point? I know you have been focusing a lot on the SME and individuals, and also what I just had a chance to see the test that the central bank published yesterday, and which was significant in terms of if you compare to other stress tests, in terms of the results, right, that the central bank did. in your case, I mean, I wonder if you could share if you have done, any stress test, in light of the situation. If you could share with us what, your capital position would be in a very, let's say, a harsh scenario, or in terms of impact of provisions as well, cost of risk, that'll be helpful.
Marcelo, really, I'm not sure I understood quite well your question, given that your voice was not very clear, but I understand you asked about the health of the corporate loan book and the stress test the central bank have run on the financial stability report yesterday. Those were the questions, basically.
Yeah.
Okay.
Yeah. And my question related to the stress test is whether you have conducted a stress test, as well, and if it would be possible to share with us, what the results would be in terms of a capital position, what would be a stress scenario for increase in provisions or anything like that.
Mm-hmm. Yeah, unfortunately, we constantly run our stress tests, not only in crisis environments, but basically constantly. But we don't share that. What I can say is our view that we are in a very comfortable position regarding the capital position is related to our stress test. We see for sure, and at this moment when we don't even know when the economy will be up and running again, it's always hard, but basically our base case stress test really show that we are in a comfortable position. In terms of corporate, I don't know if you would like. Okay. In terms of corporates, we see the corporate book in a much better position at this time. What we saw was a run for liquidity in the beginning of the crisis, but companies are mostly held with unleveraged. They haven't been investing too much. Some of them surely will face difficulties in terms of having their results and revenues cut. But in general, I would say companies with the proper amount of liquidity are going to be able to make it through the crisis. And basically, even the most complicated cases from Lava Jato actually have already been fully provisioned. Most of them we have even written off from our books. It's always possible we find some cases in a more difficult situation during the period of the crisis, but I would say this time it's not going to be a large number as in the other crises. And in that sense, we are prepared to help them to renegotiate, to try to improve our positions in terms of collaterals. I think it's fair to say that the most difficult segment this time doesn't seem to be the corporate segment.
And just to add to what Firetti is saying, it's much more like an opportunity for us, because basically the corporate was being financed by the capital markets, and therefore we saw as an opportunity because we were able to charge very good spreads and to rebalance our portfolio risk as a whole. Thank you.
Our next question is coming from Mr. Henrique Navarro with Santander. You may proceed.
Hi. Thank you very much for the opportunity. My question is on fees and commission. This revenue line is directly linked to the sale of banking products in both traditional channels and digital channels. So I would like to hear from you how the number of branches that are closed right now. When do you expect to reopen the branches? From February to March, how was the impact in sales of banking products on traditional channels, and what was the positive impact on higher sales on digital channels? So anything you could shed a light and help us to understand the impact of the coronavirus on this 6% decline in fees and commissions on the first quarter, and then maybe we can try to understand what could be the impact for the next quarter. That's it. Thank you.
In terms of branches, Henrique, actually, we didn't close any branches. We are during the coronavirus crisis. We only the branches in the malls and the ones that we couldn't open. We kept all of them open in the places we could. So we operate with different with half of the people in the branches in terms of staff, and replace this staff every week. In terms of reduction in numbers of branches in the first quarter, we closed 78 branches that actually will be definitively closed. We expect to close this year more than 300 branches. In terms of digital channels, in our case, we had already a very high level of penetration of digital channels. I think we had about 17 million clients that were clients either of mobile or internet bank, and with a very high level of usage. Due to the characteristics of the crisis, with the economy really is slowing down, we noticed actually that even though we see more clients active using the digital channels than usually, internet or mobile, number of transactions actually reduced. Basically, people are buying less things, people are transferring less money in business, payment, etc. So that's kind of the trend we have seen. I don't know, maybe I may have lost part of your question.
No, that's it. Just still on my question, the 6% decline in fees and commission income quarter over quarter, how much of that you believe is related to the coronavirus?
I would say the reduction in credit cards is pretty much related to coronavirus. It is the impact of the lower retail sales on Cielo, in our interchange revenues, that is basically based on sales. The consortium operation may have some impact. Investment bank, we were expecting a good quarter. Actually, there was the performance was not as good as expected, even though it's much better than last year. So maybe more clearly on credit cards and maybe investment bank. maybe a little bit also on asset management.
Okay. Thank you very much.
Thank you. Well, thank you all for your participation. I guess we finished the Q&A session.
Since there are no further questions, I would like to invite the speakers for the closing remarks.
Okay. Thank you all for your participation in our Q&A session and for making the time to join us in our conference for this first quarter. Have a great day.
That does conclude Bradesco's conference call for today. Thank you very much for your participation. Have a good day.